Hi. For many business owners, tax planning begins in May or June. That's usually too late. Smart tax planning is not about last-minute deductions or scrambling before 30 June. It's about making better commercial decisions throughout the year, with the tax consequences understood in advance. So the ATO doesn't penalise good planning. It penalises arrangements that lack commercial substance, where it's, crossing the line. So if a taxation transaction doesn't make sense commercially, then the ATO is likely to argue that and audit you accordingly. So tax planning is about timing and character, not just the amount. So most tax surprises arise because, not because income is high, they arise because the timing and the character of the income is misunderstood. So there's a situation where two businesses can earn the same amount, yet produce a very different tax outcome depending on when the income is derived, whether it's revenue or capital, how distributions are structured, and which entity actually earns the income. So understanding all those distinctions is foundational to business tax planning. So there's 7 key categories. And if you break them down into these categories, it's easier to manage because then you focus on each one. Number 1 is income. Number 2 is deductions. Number 3 are loans and losses. Number 4, capital gains. Number 5 is superannuation. Number 6, GST. And number 7 is general strategy and risk. So each have their own issues and each have their own strategies that you need to consider. So income is about when and what is being taxed, and it's not always straightforward. So you need to ask yourself a few questions. Can revenue legitimately be deferred or brought forward, depending on your situation? Are there any disputed or conditional invoices? Have grants or insurance proceeds been received? Trust distributions expected? Is dividend income franked or unfranked? Does personal income services apply? So you can see that there are many different issues, and understanding how each can impact is very important. Deductions. Well, think commercial first and tax second. So purely buying something to get a tax deduction really saves you money. So spending $10,000 to save $2,000 in tax leaves you $7,500 out of pocket. So that doesn't make it wrong necessarily, but does it make commercial sense to do so? So again, some key questions you've got to ask yourself. Are expenses of a capital rather than a revenue nature? Can capital costs qualify for the 5-year black hole deduction? Are bad debts generally written off? Has trading stock been correctly valued? Are repairs deductible or are they capital improvements? Are bonuses approved and paid for? Are prepayments being considered? Are the depreciation concessions available? So all of those things can make a big impact to your deductions. Then we get on to loans, losses, and Division 7A. So this is where it's really all about your structure. So if you're operating through a company and funds move to shareholders or associates of shareholders without proper documentation, then Division 7A can treat those payments as unfranked dividends and trigger additional income at higher tax marginal rates. So you need to be able to make sure you manage that in the most effective manner. It's not about not taking the money, it's about how you account for that and doing so in the most tax effective way. Capital gains. The problems start before the contracts. So capital gain tax planning is really happening at the very beginning when the asset's acquired. So when reviewing for capital gains tax planning, consider, have assets been sold or transferred? Are property activities on revenue account or capital account? Does the 50% CGT discount apply? Do small business CGT concessions apply? Are loans forgiven or restructured? So there's quite a number of issues there that can make a really big difference in terms of your income in any given year. Then we get on to superannuation, and it's really about timing. And superannuation can be a very, very effective tax planning tool. So to be deductible, super contributions must be received by the fund before 30 June. So not just paid by you, so paying in the last day or two, you may miss out, because if the fund hasn't received it, then it's not a deduction. So you then need to consider what type of contribution you're making. Is it a concessional contribution, which is tax deductible but taxed in the super fund? Or is it a non-concessional contribution where it's after-tax monies but not tax going into the super fund? Are you monitoring your concessional and non-concessional caps? So currently it's 30,000 for concessional contributions and up to 120 per year for non-concessional. So managing those is important. Are personal contributions deductible? Are your superannuation guarantee obligations being applied correctly for all of your staff, for any bonuses, for contractors? So all of these things are important. And then there's Division 293 tax, and whether that's been triggered for you based on your total taxable income in any given year. Super is powerful, but requires some planning and precision. Then there's GST. GST is really a cash flow issue. So in reality, GST problems are cash flow problems before they're tax problems. So is the business correctly reporting, whether it be on a cash or an accrual basis? Have there been changes in business versus private use? Any of these adjustments, and obviously accounting for GST correctly in the first instance, are important because they're going to make a big impact on what your GST commitment is, because that is either quarterly or monthly for some businesses. So understanding that you've got that cash flow, regular cash flow commitment is important, not just the GST amount. If your books are being reconciled and coded correctly, the GST amount will take care of itself. But the cash flow issue doesn't take care of itself unless you're planning for that. And general strategy and forward planning. So strong tax planning extends beyond just those individual items that we spoke about, revenue, income, GST, losses, etc. It's more a broader issue of, is your business actually structured correctly? Does it suit your circumstances? Does it suit your business and business type? So whether that's in a company structure, whether that's in a trust, are trust deeds updated? Are any trust elections being made that can impact? Are the beneficiaries accounted for correctly? Are profits being retained in an appropriate manner? Are any major transactions planned in the next 12 months for your business? So all of these things you need to be considering and planning, because they're going to have a financial impact and therefore a tax impact. So understanding that earlier in the process puts you on the front foot, doesn't make you reactive, doesn't catch you out, doesn't give you a surprise that is not a pleasant one. So we need to make sure that you're planning, whether it's for growth, whether it's for asset protection, whether it's for cash flow, whether it's for an exit strategy. So making sure you're doing that is important. And ideally, you need to be doing that regularly. There's the pre-30 planning, yes, we know that, but a mid-year review plan is also advisable before any major asset purchases or any restructuring of the business or before any distributions or before selling any assets. Tax planning needs to be done at all of those points, and those points generally happen anytime throughout the year, not just pre-30 June. So tax planning is not about being clever. It's about making informed, disciplined, commercial business decisions with tax consequences that are understood in advance, not after the event, right? So being a step ahead gives you a better chance of managing the tax, managing the cash flow implication, and making sure you're achieving the best possible outcome for you and your business. Good tax planning doesn't chase deductions. It protects profit and protects ultimately the bottom line for you. I know there was a lot to unpack there. Hopefully I've given you a good understanding of really what you need to be doing in your tax planning. If you need any assistance, reach out. Clearly, that's our bread and butter. That's what we do. And we love to help and support you and your business. Hope you found all this valuable. Look forward to speaking again with you soon. Bye for now.